Apple isn't just a company, it's a lifestyle. From iPhones to AirPods, they are everywhere. With a market cap close to $3.5 trillion, here's the question. Is this still the safest growth giant or the most overpriced fruit in the market? Hi buddy, my name is GB Rohit. I try to make finance fun and approachable. Today, we are talking about Apple, whose phone is probably on your hands right now. Now, Apple is the crown jewel in every investor's portfolio and has been the darling of Wall Street for years. But in 2025, the big question is whether it still deserves that status. So, today we'll break down its fundamentals, growth story, risks, and what anyone should do. In 2024, Apple made $391 billion in revenue, which is up 2% from the year before, and a 5-year revenue growth rate of 9.2%. That is wild when you consider they already control a massive chunk of tech market. And let's not forget their services business. Apple Music, iCloud, Apple Pay, App Store. This segment brought in $96 billion alone. That's high margin and more predictable revenue than selling hardware. And this segment accounts for 17% growth rate in the last 10 years. Interestingly, this is the only segment which showed consistent growth in the last decade. Apple has transitioned from being a product-driven company to a service-oriented one. While the iPhone remains central to Apple's business, hardware differentiation has plateaued. Instead, Apple's strategy has shifted towards expanding its ecosystem through services like Apple Intelligence. While products have a 35% profit margin, services lead with a massive 74%. The gap between iPhones and services is closing fast, signaling a major shift in Apple's long-term strategy. Apple pulled in a staggering $391 billion in revenue in 2024. Here are the business segments. iPhone $201 billion, services $96 billion, wearables $37 billion, Mac $30 billion, iPads $27 billion. This company prints cash. In 2024 alone, Apple generated $108 billion in free cash flow. That's the kind of financial fortress you want in your portfolio. Alright, let's crunch some numbers. Apple's current PE ratio is 37.8, whereas the tech sector average PE ratio is 37.6. Does it mean it is overpriced? Maybe, but here's where things get interesting. 5-year revenue growth rate of 9%, net income 16%, free cash flow growth 10%. 5-year average PE ratio is 29, return on invested capital 50%, price to free cash flow is 29, earnings yield 4%, debt to free cash flow 1.35, current ratio 0.86, and continuously reducing shares outstanding. When compared with the long bond yield of 10 years and 30 years, free cash flow yield is only 3.14%, whereas 10-year bond yield is 4.63% and 30-year bond yield is 4.86%. So what next for Apple? Let's talk about the shiny new toys and their potential. Apple stepped into mixed reality space with Vision Pro. The adoption rate is still niche, but it was estimated it will set a stage for $1 billion market. With mixed reviews and a price at $3,500, it's a risky gamble in a market with lukewarm interest. Expansion into India and emerging markets. In 2024, Apple's revenue in India increased by 36% compared to last year. With massive growth potential and growing middle class, Apple is betting big here. Yet, affordability remains a massive hurdle. An iPhone costs nearly half the average Indian annual income. Apple chips are insanely powerful, and everyone thought that AI integration will make their ecosystem even stickier. But that AI is a disaster. Slowing iPhone sales. It's a classic big company problem. iPhone is still their bread and butter, and that growth has been flattening. From Samsung, Microsoft to Google, everyone is gunning for Apple's throne. At the same time, Apple is also losing its dominance in China. As the data suggests, recently iPhone shipments have fell 17%. Of course, it's not all sunshine and rainbows. Let's keep it real. Price is what you pay, value is what you get. At $229 a share, Apple isn't cheap. Here, we are paying for safety and brand dominance. But the big question is, how much is too much? Overvalued or undervalued always depends on how much returns we are expecting from our investment. At 10% return with a perpetual growth rate equivalent to US GDP growth rate of 3.1%, the fair value is $120 a share. With a much more conservative and a safer perpetual growth rate of 2.5%, the fair value dropped to $112 a share. With these valuations, Apple is clearly overvalued. If you want to know in-depth analysis about Apple stock, I'll be soon posting this entire detailed analysis in my newsletter this week. Subscribe for that.